Welcome to the series. We were talking about a guide to international business from a trade finance angle. In this introductory course, the third session, we are talking about what is trade, an in depth analysis of trade. Trade, in its simplest form, is exchange of goods or services between at least two parties. This exchange transcends national borders, then it becomes international trade, and international trade is a cornerstone of globalization. International trade drives economic growth. International trade causes innovation, and international trade aids in cultural exchange. It allows countries to specialize in the production of certain goods and services where they have a comparative advantage and allow other countries where there is a demand for such requirement. Thereby, it brings about efficiency and welfare. This is democratization in a form. In this comprehensive analysis, we will try to explore the concept of trade, the characteristics, the evolution, the benefits, the challenges, etc. Definition of trade. Trade is a voluntary exchange of goods and services for commercial benefit between two parties. It can occur within the country domestic trade or between different countries, which is international trade. The primary objective of trade is to satisfy the needs and wants of individuals through the entities by leveraging the resources, skills, capabilities of other countries. In international trade, we see exchange of capital or goods or services across the borders. It is called import. That is, goods are brought from into a country, or export. Goods are sent out from a country. And unless domestic trade, international trade is influenced by more complexities in the form of tariff, currency exchange, and other geopolitical considerations. Let us turn our attention to the characteristics. International trade differs from domestic trade in a variety of ways. In domestic trade, buyers and sellers are usually located within the same country. In international trade, the exporter and importer are separated not only by the national border but by their regulatory, cultural, and other differences. So it needs logistical coordination for the goods to move and other considerations for the payment to be secured because of the regulatory differences. Then comes the foreign currency issue. Cross border trade is usually done in the another currency or a third currency, not the home currency of the buyer or a seller. There is an exchange rate fluctuation when you convert the buyer's currency into the currency of the transaction and the currency of the transaction back into seller's currency. This is the foreign exchange fluctuation or the volatility risk that you undertake in a cross border trade. Then there are barriers. Unlike domestic trade, cross border trade is subject to various barriers such as quotas, embargoes. Quotas will prefer a certain party, embargo will prevent a certain party, tariff, which will allow people but with a special price that you pay in the form of customs and excise duty. Then there are licensing requirements. Then there are standards for various products imposed by the government. So this will have a influence on the regulation of the import or export flow. The transportation cost. The goods or service needs to be moved across the border. And for this, there is a cost involved. The freight forwarder, the loading unloading, the warehouses, the customs bond. These are not there in a domestic trade. The mode of sea is a cheaper mode of transport, but it takes longer time. The transport by air is easier and better, but has higher cost. So the distance, type of goods will decide upon what is the mode of transport that you might choose. Then comes the legal and cultural considerations because there are different laws, different languages, different cultures, different beliefs, different traditions, different practices, different ethics, different etiquettes. These can create challenges in enforcing a contract or while negotiating or even at the time of marketing a product. Let us now turn our attention to the historical evolution of trade. Early trade routes. Trade has existed for millions of years. In the sense, from the time the civilization started growing on the banks of various rivers, for example, Mesopotamia or Nile Egypt, or in Greece, or in India, or in China, people started going by caravans and others long distances across various countries. This is what we called as a Silk Route when it happened over the road. And then explorers started discovering various sea routes to different countries, and then a maritime network in the Mediterranean Sea got established. So trade has been happening for years. The age of exploration, there was an expansion of international trade because bigger ships and faster way to reach another country was established by the European powers to their colonies and the trading posts worldwide. Then came the Industrial Revolution. Because of Industrial Revolution, the developed economies of the West were able to produce more at a cheaper price, and they wanted to find markets for that. Because of the advancement in the technology of production and in transportation, they were able to move the goods faster. And because of the established communication channel between two countries and cultural nuances being understood, free trade policies was also introduced. Post World War, there were efforts which were characterized to liberalize the trade, and institutions like World Trade Organization, General Agreement on Trade and Tariffs were brought in to facilitate cross-border interactions in trade. In the modern era, it is not only liberalization or globalization or privatization, it is not only technological advancements, but it is e-commerce that has made access to information to everybody, everywhere, anytime. So the regional integration agreements between the European Union had created a customs bloc or a trade bloc. Then you have free trade agreements like NAFTA or ASEAN. The emerging economics like China and India are able to provide a variety of goods to every market in the globe. So e-commerce had helped trade become more democratized today. Let us now look at various benefits of international trade. International trade offers numerous advantages to various countries. One is economic growth, the expanding markets for domestic producers, increasing export revenues, earning foreign currency, creating jobs, fostering innovation. These are all triggered by the exports. Then comes the specialization and comparative cost advantage, which causes the export. Countries can specialize in producing goods where they have a comparative cost advantage, where they have a lower opportunity for cost and availability of skills. And then they will import goods which are more efficiently produced elsewhere. Even importing semi finished good and converting into finished good could be a viable commercial activity in cross border trade. Access to diverse goods is a result of international trade. A variety of goods and services are available at competitive prices because you are able to import from different countries. Economies of scale. One company cannot produce to meet all the needs of the whole nation. So, what happens? Producers can achieve economies of scale by expanding their operations to serve multiple markets, and thereby the seller will be able to sell at a price which will be more cost effective for the importer than they themselves producing it due to absence of economies of scale. Enhanced competition is another benefit of international trade because exposure to international markets helps us understand what is available where at what price, what is driving efficiency there, how the cost and the price of the goods and the interest rate or the inflation rate or the other aspects is influencing ability to do business, and from there the local corporates can learn and improve the competitiveness. These benefits does not come free, they come with a variety of challenges. The challenges are widespread and complex. Most important of them is a trade barrier. The tariffs, the quotas, the embargoes are different types of trade barriers that limit the market access. Then is the currency fluctuation, which is market related. The foreign exchange rate volatility creates uncertainty. The political risk, which is the most unpredictable of all the risk because of the geopolitical tension or the sanction or the regulatory change or the disruption in the rules that will create an impact on your ability to trade across another country. Compliance cost. Corporates need to navigate the complex regulations. There are various documentary requirements from the customs and other angles. The requirements should meet the local standards and then protect your intellectual property and then ensuring there is a minimal damage to the environment. At the same time, keeping in mind the cultural nuances of the local market. What are the mechanisms that facilitate trade? There are various mechanisms that help in smooth cross border exchange of goods and services. Most important of them is a trade agreement, which is a bilateral or a multilateral agreement, and it reduces barriers to trade by establishing FTAs, free trade agreement nations, or most favored nation status, MFN status. For example, the United States Mexico Canada agreement could be considered as a facilitator for export from US and import to US of the various goods made in Mexico or Canada or required by Mexico and Canada. Trade finance instruments like letters of credit, bank guarantees, documentary collections help buyers and sellers to secure their payments. At the same time, mitigate the risk associated with a cross border trade by ensuring performance by the supplier is in place. Supply chain management. Physical supply chain needs to be well managed to ensure timely supply, to ensure goods to prevent them from pilferage and leakage, for which we need adequate insurance cover, a good warehousing or a logistics company, a cold chain if required, and inventory management. Now, the future of trade, the technological advancements in the form of Internet of Things or a blockchain is helping transparency and traceability. Regional integration, like the European Union or the African Union, is creating a free trade bloc to help each other sell and buy from one another country. The sustainable trade requirements are growing day by day because they are incentivizing certain sectors for behaving in a eco-friendly fashion. Then in the emerging economies, there is a need for goods because of the expansion in the market, expansion in the spending power. Also, there is a capability to produce which needs to be sold outside. The trade is continuously evolving despite the challenges. The geopolitical, economic, and environmental challenges can be handled by proper understanding and due diligence and ensuring communication with the various partners and specialization in your area to ensure that your goods are not only sought after but the corporate is well positioned for this trade. Thanks for watching this video. We will catch up in the next session on the series of understanding cross border trade.